We are back talking about the fixed income markets and what is the expectation, at least in this final quarter of the year. Sterling Capital, which is a local investment bank, this week published a note with regards to the fixed income market, their outlook on trading as well as their outlook on what government will be looking to get from the domestic market and at what prices. In general, Sterling Capital is saying this: liquidity is sort of drying up. It had not been the case in the last 3 months, and they actually expect less money to actually come into the government auctions, either for the longer dated papers, anything over 1 year, which we would term as the treasury bonds, or anything below 1 year, and that's the 91-day, 182-day, as well as the 364-day. The key thing that Sterling Capital is looking at this month, the government has reopened 2 papers, and that's the first issuance for 2018, and this was for a 15-year term, as well as the second issuance for 2019 over a 15-year term. The government will be looking to raise money for budgetary support, and we want to see what is the pricing that the government will be looking at, as well as what is the outlook for fixed income assets for the next couple of months before the year turns. Before we get into this particular report, we want to give you an update with regards to the Emma Kiba. The Emma Kiba is an online mobile investment platform where the government has opened up its treasuries to the public for people to be able to buy fractional elements of government bond papers for a return. This has been done on the phone. It has been a very innovative move and a way of the government trying to break down the opportunity for investing in government debt to everybody at the bottom of the pyramid. For this issuance that has just closed, the government was looking to raise about 500 million shillings. They fell short of that amount by almost 50%. They were only able to raise 264 million shillings. The only thing that was positive from this issuance was the fact that the number of accounts that are trading on Emma Kiba increased. The total accounts that we have in circulation are 52,000. But it seems it's a similar case as to what is happening with regards to the NSC trading. When the Nairobi Securities Exchange opened up its doors for people to invest in Safaricom, there was a huge increment with regards to investment accounts and retail investment accounts that were opened. As of today, we have 1.4 million tradable accounts on the NSC. Only about 10% is actually active. That's about 140,000. So you have an element of Safaricom opening up that market, but then people have not been trading in that market. Now on this other side, you have Emma Kiba. The first time that it came through, it was actually able to surpass the amounts that the government was trying to raise. This time around, it was looking for 500. It has raised about 263 million. But you can see the number of accounts has increased. 52,000 accounts that are there. But it seems that the active accounts are much less, and a similar case to what is happening on the NSC. The question then is it that people lack the requisite information to trade? Do they need to be reminded that this is an investment opportunity, or are they losing money? So is it an element of people are not empowered with the right financial knowledge because their tools are actually there, or is it that they don't have money to be able to invest? That is something that we will be investigating, and we will come back to you on that. We shall come back to the report by Sterling Capital. We'll put up the first chart there, just showing us a historical summary of the last auctions for bonds that the government had actually put out, and that would be chart number 1. So we had mentioned as we started the show, 2 things are happening this month. The government is coming back to the market looking for about 50 billion shillings. How is the government going to raise this? It has reopened 2 15-year issuances. That's the second auction for the 15-year paper that was issued in 2018, as well as the first auction for the 15-year paper that was issued in 2019. Now, Sterling Capital thinks that the subscription for both papers will be about 60%. And the reason that they think there'll be an undersubscription is the fact that there's not sufficient liquidity in the market. What typically happens with the government calendar year, it closes the end of June, starts 1st of July. So July, August, and September, there's a lot of money that gets into the economy. Outstanding invoices are paid. Outstanding contractor invoices as well are also paid. So you tend to see a huge injection of money in the first quarter of the government year, and that's July, August, and September. When this begins to dry up, then liquidity is actually sucked up from the market, and this would explain why Sterling Capital actually expects an subscription for this paper. This is what I find interesting. So for both papers, Sterling Sterling Capital thinks that the demand for this paper will be priced at about 12.3 to 12.5%. This is for the 2018 reopen, and about 12.5 to 12.6% for the 2019 reopen. Put simply, if you're putting away your money for 15 years and you're giving it to the government, you will expect to get a return of anything between 12.3% to 12.5%. I think that seems like a very, very low return, but it's important to actually use that as a benchmark when you're investing in any other opportunities. We tend to invest thinking we can become millionaires overnight. Those are far and in between. It's very hard to find a unicorn, something that gives you 100% and makes you a billionaire overnight. When you're looking at 12%, what this means is if you put 10 million aside, you will make 1.2 million in a year. That comes down to less than 100,000 in a month. So really, you have to have started investing when you're very young. It's actually more important to start when you're 25 or closer to 25 than when you're actually about to retire. Now let's go back and look at what has been the performance for the last issuances that the government has given. So we have our summary table there. So we saw a very huge improvement with regards to the performance rate in July 2019. The government was looking for 50 billion and the bids that came in were 86 billion. The pricing for this paper was 12.3%. This was a 15-year paper. Very good performance rates there. But you can see the traction on the coupon rate, 12.3%. That's in line with all the other 15-year papers. The liquidity, which is what we've been explaining, is what explains the 216% jump in that particular year. Then you can actually see the last paper in that particular table that was in same time, almost less than a year ago. That's in October 2018, where the government issued another 15-year paper. The amount they were looking for was about 40 billion. The amount they received was 27 billion, and the pricing for that paper was 12.75%. Now, this is important because you can see as we ease away from the beginning of the fiscal year, the liquidity begins to dry up, and there's not too much money that's in circulation. And that would explain why the expectation is to get a 60% subscription level for these papers that are actually out in the market as at this point in time. Let's move on to the next graph, and we're looking at the domestic debt subscription rates. How much is the government looking to get from the market, but how much is the market actually able to put out for these issuances? That is graph number 2, and our graphics team will put that up for us, please. So there you have it. There's a very good summary there, starting off from January all the way to August. Just by way of explaining what this chart means, you can see the columns. That's the light blue color. That's the amount that has been offered, the amount that the government was looking to raise. The light blue line chart, that is the amount that was accepted by the government, and then the dark blue is the amount that was received by the government. You can see there at the last auction that we saw, the government was looking for, you can see at the very end, the government received bids of about 67 billion, but accepted bids for 60 billion. But you can see that it's been quite volatile by slightly huge improvement, especially at the tail end of this chart. And you can actually see there what we were saying, what tends to happen when the government closes its books, and just before it closes its books, you can see a traction all the way from February up until August, and it peaked in March, just a few months, the last quarter of the government here. So this tends to be a period when there's a lot of liquidity that's getting into the market. In as much as money supply has not been growing as fast, if you actually look at the chart at the beginning of the year, the supply of funding was actually tighter in January in the previous year. And the rationale for this is very simple. When the rate cap happened, there's not been much money that is actually being created or circulating in the economy. And at the onset of the rate cap, that is in 2016 and in 2017, the government, the investors rather, the pension funds and the banks actually put in a lot of money, and that began to sap liquidity from the economy. And you can see a bit of a slowdown here. And then when contracted payments started towards the end of the fiscal year and the beginning of the fiscal year, we've seen an improvement with regards to subscription levels, with the market actually getting to 145 billion in February and the government only accepting 53 billion of that. We move on to the next issuance, and that is graph number 3, the bond subscription analysis. What is actually happening there? Again, a summary of the same, or the only difference being that this is really looking at the longer end of the paper. This is bonds, and it doesn't calculate the T-bills. So similar trajectory there that we have. And that's the next. So you can actually see at the end of the year, we had 60 billion that was accepted. That is August at the end of the curve. And the amount received was 67 billion. Really, what we're saying is that the government securities have continued to decline since the introduction of the interest rate cap. And we're seeing an explanation with regards to how much money is actually available to the government. But for your benefit, even as we come to the end of this, it's important to note that there's been an improvement on liquidity. And all of this has a lot to do with money circulating in the counties, money being released for contractor invoices. And you can see that the subscription levels are over and above what the government was actually looking for. Let's move on to the next slide. And that is that's chart number 4 for us, just giving us an element of what is happening with interest rates. Okay, so we're looking at our interest rates. I think our graphics team, that will be chart number 4, the one just before this. Two things are happening here for the T-bills and for the bonds. So we're looking at the short end of the paper. That's the 91-day bill in the blue color at the very bottom. Then the middle one is 182 and the top line is the 364. We've seen more interest in the 364-day T-bill. It did close at the end of last week. It was flat at about 9.03%, and you can see the interest rate for that particular paper has been more or less flat. What we have seen is a bit of slight volatility on the 91-day bill, and this was in November 2018 through to January of 2019, but it's corrected. But with regards to liquidity and investor appetite, two things are out. So the conversation on the rate cap is ongoing, and the jury is still out on that. What we have seen is we've seen banks and pension funds actually preferring to either go for the 91-day bill or to go to the furthest, the 364-day T-bill. Nobody wants to play in the 6-month paper market. It's either the 3 months, which takes you to slightly before the close of the year, or the 1 year. The 1 year is at 9%. The 91-day is now closing at 6.3%. So not too much interest on the 182-day paper. Let's move on to the next slide, which just shows us an assembly of what is happening with regards to the commercial bank liquidity. And that would be graph number 5. So as we touch this, this is a very important parameter when you're looking at the government of Kenya bonds market. The central bank, rather the commercial banks, provide the largest liquidity when it comes to trading in this market, followed by the pension funds. The pension funds are about 20%. The commercial banks tend to be anywhere between 50 to 55%. So the liquidity is important and gives us a depiction of what do we expect when the government comes to collect paper. But before touching on this, when we have looked at the short end of the curve, so 91-day, 182, 364-day paper, the preference there is for the 91-day paper at 6.3%, or the 1 year paper, that's a 364-day paper. Now, for anything that's over 1 year, stretching all the way to 20 years, demand has actually started settling in at about 10 years. And now for the last auctions that we have seen, we're seeing people saying they want slightly shorter paper, especially if they're trading it on the NSC. And the jury is out here, because you're saying if you're going to receive 12.34% for paper that is 15 years, and for paper that is actually 10 years, you're going to get something similar, about 11.6%, 11.7%, depending on when you buy the paper. Then people are saying, let's put our money in the 10-year paper. And more importantly, for the commercial banks, if I'm sitting in Treasury today, two things are going through my mind. This rate cap conversation. Now, your typical debt is normally 4 to 5 years. Let's give it an average of 4 years. So I want to see what will happen with this the central bank rate conversation with regards to the rate cap. Is this going to be abolished? Is it going to be amended? If nothing is going to happen there, as I await that decision, it's in my best interest to actually park paper in the shorter end of the curve as opposed to going to the longer end of the curve. And that would be the rationale where we are seeing people actually coming for the shorter dated paper, the 10 years or the 5 years. Now, the argument here, or rather the point of conflict here, is this. The market wants shorter dated paper. The government of Kenya wants longer dated paper. The government needs to extend the maturity of the papers that it is issuing so that it can stop getting into the element of having a cash crunch every time it's reading its budget. The average maturity for the entire debt portfolio for the government is about 4.4 years. They want to be able to move this north of 10 years. So you will keep expecting issuances of 15 years, or even 20 years, or at least infrastructure bonds. And the thing is, the market will keep telling the government, we are not ready for this paper. We want shorter dated paper. That's the risk we want to take. So expect continued undersubscriptions with that regard. Now, looking at the commercial bank liquidity, you have a chart that details how that liquidity line has been looking from January 2014 up to May 2019, and that is the last. That's the latest data that we've actually seen come out. So the very bottom line, that's looking at the average interbank lending rate, and then the blue line that is there, the middle blue or black line, that's the total commercial bank liquidity ratio, how much money is sitting in short-term paper at the banking sector. And then the other line, which is the blue line, sky blue line, that's the private sector credit growth. This is again important. So 2016 tends to be the date that we're always looking at. 2016, August of 2016, there was a cap. The rate cap actually happened, and that changed the dynamics of the Kenyan banking sector. But prior to that, there had been a continued slowdown with regards to private sector credit. And this slowdown started in September. And if you recall, if you have any facilities in the bank, this was the time people were paying 24%. Some people, even SMEs, paying north of 30% from credit from the banking sector. So this actually started to create a bit of a problem with regards to non-performing loans and the affordability of this credit in as much as it was available. This necessitated the move by the government in August of 2016 to cap the rates and change the dynamics of this particular market. So you can see prior to 2016, liquidity in the banking sector was more or less flat at about 40%. And then when this spike happened, it moved closer to 50%. And there are some banks, at least in the tier 1 sector, that we tend to see liquidity ratios reported of about 60%. By liquidity, the banks are putting money with the government, and that counts for liquidity, or they're holding cash reserves. That is graph number 5 that we are looking at. Very interesting thing that we need to focus on is the blue line there. So a correction on private sector credit growth coming from coming to a low of about 4.2%. This slowdown September 2017, in 2018, very muted growth with the private sector credit, with the banks preferring to give their money to the government of Kenya as opposed to lending it to the private sector. You can see a slight recovery up until May. The last reported number with regards to private sector credit growth is 4.2%. This is a very pertinent thing to look out for. Reasons being, one, if the rate cap conversation remains as it is, there's still demand for credit, and the banks have been able to figure out a new model of being able to price in risk and continue to extend credit into the sector. So we expect slow growth, slow but gradual growth if nothing changes. If anything changes on the rate cap, whether an amendment or a total abolition, then this could actually go to double-digit numbers in the next 18 months or so. And it's always a very good thing to look out for, especially if you're looking to invest in the Kenyan banking sector. That sector is trading at a discount to its book value. The price to book value is a parameter that we will be looking at with regards to valuation. The last number that we saw last week is 0.87 as a totality for the sector, for the banks that are listed on the Nairobi Securities Exchange. KCB 1.1 times book, 8% dividend yield. Very interesting counter that we have there. Equity Bank 1.5 times book from a high of 2.2 times book in 2016. Again, another very interesting counter that we're seeing there. Cooperative Bank 8% dividend yield, a very interesting counter that we are also seeing there. We move on to the next chart. But as we are closing this particular section, remember, we're talking about the dividend yields. How much can you get if you actually put your money in this banking stocks? So we mentioned KCB 8%, we mentioned Cooperative Bank 8%, Barclays Bank is paying the highest at about 10%. Now you have 10% and you put your money there and you're guaranteed of getting a 10% dividend return, and you also have the opportunity to get a higher price if the market corrects upwards. Now on this other side, you put your money in government paper, 15-year, you're getting anywhere between 12.3% to 12.6%. And that explains where we've actually been seeing lower money subscription rates going into the government, and with a slight shift of money coming into the equity markets. So we expect a reallocation of funding by the banking sector as well as by the pension funds. The pension funds have the opportunity to invest either in fixed income, that's government bonds or equities. We are seeing them coming back into the markets and chasing yield. We've been seeing a lot of demand on the banking stocks. 23 million trade that went through on Barclays Bank of Kenya this week. That 10% yield is something that you need to look out for. For the banks, they're becoming less averse. They don't want longer dated paper. They do want shorter dated paper. I think so. As we come to the end of our show, this is really what we are seeing and what Sterling Capital is saying. Expect tighter liquidity situation in the short term, if nothing else, because there's not too much money that is actually circulating in the economy. And expect the bearers of this capital, that is the banks and the pension funds, to demand shorter dated paper, and also expect the government to keep putting out longer dated paper. In other words, the government will keep demanding for 15-year paper and above because it's in its best interest to lengthen the curve of the money that it's actually borrowing from the market. But what's the final word when we're looking at the foreign debt markets? From the last papers that we saw with regards to the budget, the government was going to raise about 300 billion from the foreign market. We had the sounding of a syndicated loan earlier in the year, but that went mum. So we are yet to see whether the government is still going to look at the global credit markets, which still look favorable. When we talk to the credit companies out there, they keep saying that Kenya is okay, the debt sustainability is okay, and the refinancing risk is near to zero. What that means is if the government cannot get sufficient subscription rates locally, expect it to keep borrowing out from the market in the external credit markets. Now, the only caveat is this: what will the MPs do, and can they do anything? They're already talking about a need for a cut on expenses and also a need for a possible cap on how much the banks can actually extend to the government and how much the government can take from the local and the foreign markets. Nothing has been put in paper. For now, it's just talk. Thank you for joining us this afternoon, and we just want to urge you, go and begin to look at equities at this point in time. See if you can get a better yield. If not, look at the Emma Kiba. That is an option for you for investing. And if you're also not interested in that, speak to your banks and begin to look at some of the infrastructure bonds that are coming out there that can give you a good return. Thank you for joining us this week. We will see you again on Monday, and that is 2:30 Markets Today on Metropole TV. Good afternoon.